great, Vinod. Great catching up with you after long. Vinod, I would like to go back in time and probably look at the entire journey which you have had in, so to say, in the banking career as well, because I knew you made the switch from banking to venture debt. So, in terms of a career progression also, I know it can be something like a valuable lesson for our audience. So if you could just go back in time and let us know how the transition happened for you.
Sure. It's an interesting question. I haven't thought about that for some time. So I've been working for 20 years now. I actually started my career as a brand manager in ICICI Bank. Right? Yeah. So I was actually into marketing. So I wanted to do a lot more in the branding and marketing space. So I spent about 3.5 years in ICICI Bank. But I had the opportunity to switch between different roles and spend some time in branding, in the rural business team, where I actually ended up learning a lot about real India, the Bharat story. But this was way back in 2004.
Okay.
And moved to corporate banking, mainly to get over my fear and ignorance of finance. So while I done MBA, I never did any courses in finance, and I realized that it's not something that is tenable. So in 2006, I actually moved to Citibank, and there I joined the corporate banking team. I was managing large corporates in auto, healthcare, and consumer.
Yeah.
As well as media. So it was an interesting set of companies that I was kind of managing in terms of relationships. But this was still conventional banking, right? So ICICI gave me a little bit of breadth in terms of different kinds of roles. Sure. Citi was a very sophisticated bank, and you have a cross-border flavor to the transactions that you do.
Yeah.
But it was still the conventional world. So in 2008, and a lot of this across my journey has been serendipitous, I would say. I'd actually agreed to move to Chennai as part of the corporate banking team in the summer of 2008. This was pre-Lehman, it was a different time in banking. And on the 24th of July, 2008, because that used to be the Wi-Fi password, Silicon Valley Bank got its NBFC license, right?
Okay.
2 more weeks and I would have moved to Chennai. And, then it would have been a different situation altogether. But because it happened at that point, had the good fortune to actually join SPB and as part of the founding team for the India business. Right? Now, when I left Citi, everybody around me thought, it's such a bizarre move, right? Like, who leaves Citibank?
Yeah.
In about 3 months' time, it turned out to be the best decision of my life.
Okay.
Because the entire conventional financial world was in turmoil. And I spent some time in the Bay Area. SVB was well capitalized in India. It was newly minted NBFC. And we basically had a license to hunt and kind of grow the book here. So that phase was the next 6 years. And you asked that question earlier, what the transition felt like.
Yes.
So if you look at the conventional world of debt, a lot of it comes down to just understanding free cash flows, assets, vintage of businesses, big promoter groups, the larger the better.
Yeah.
People who've done this for decades. And then you look at startups and it's the exact opposite.
Absolutely.
Right? So it took some time, I would say. It took a lot of unlearning and relearning. But at the heart of it, Punita, I think the aspect which fascinated me was concept of entrepreneurship. I mean, I always wanted to, at some level, do something on my own. I didn't have an idea. I didn't know what it was that I wanted to do. So I kept learning. And venture debt for me was one more avenue to explore that entrepreneurial bug, right? And it was also a puzzle that looked impossible to solve. How do you provide debt to a company which is inherently non-profitable, low assets, no vintage, you don't have promoters but founders. So it went against the grain of everything that conventional debt stood for.
Correct.
And so and that's kind of my personality as well. I just like puzzles, and the more difficult the puzzle, the better. Okay? So that was a trigger as well.
And Vinod, the best of startups you have worked with and supported throughout. At what stage do you think they would come to you to look for venture debt financing?
So there's a lot of things working. I think there have been a lot of learnings along the way on business building and the markers around success.
Okay.
For say a consumer brand or a B2B platform or a fintech, lending engine, being able to benchmark that over cycles has been quite useful. The fact that I was still doing this 6 years ago, 9 years ago, 12 years ago, allows for some benchmarking across different cycles and saying what happened at different points of time, and it just helps in having some early warning signals. That early warning signal, I think, has helped both founders and us in avoiding a lot of issues. At the end of the day, I think it's good intent, hard execution, being there, rolling up your sleeves, which the founders do, right? And our role is a little bit on the periphery, I would say, right? But sometimes it's just about calling an alarm bell a little bit earlier, or in guiding founders through, what has happened before, and that kind of context helps in avoiding certain problems. So considerable learnings, and I think it's every day, and it's a constant process, I would say.
And also just to simplify things for, since many of our viewers, of course, would want to understand better in terms of whether they want to go for equity financing or they want to go for debt financing. Can you simplify the two for our viewers?
If you build good quality businesses driven by good quality revenues and a strong gross margin, not spending too much on marketing, everything falls into place, right? That should be the objective.
And lastly, a piece of advice from you to founders who are seeking financing in current times.
See, this is not an easy market to raise capital, but those are also the opportunities where strong execution comes through. So we have seen this in the last 12, 18 months, when there's been 12 months at least, there's been a bit of a funding pullback in some sense. But we've also seen amazing companies actually break through and get funded at this time. So it's not like deals are not happening. There is capital waiting to go into deserving companies, be it equity or debt. We have our highest velocity ever right now. And actually even equity investors' velocities come back, right? So I would say to founders, one is focus on execution. For young companies, prove out PMF, focus on unit economics, and ensure that the story stacks up, right? And then focus on scale, not to put the cart before the horse. For growth stage entrepreneurs, I think they need to have more resilience, prepare for longer time frames where fundraising takes time. They've already got reasonably sized, scaled businesses. Then you need to have more options, create more avenues in terms of capital solutions, ensure that the business has many, there's many doors that are opening up for the business in terms of capital, right? It's going to take time to raise money. I think that's true for almost all companies right now. But this is also the time that differentiation is easily visible.
So, on that positive note, I'll conclude the conversation. Thank you so much for taking out time, Vinod, and talking to us at Entrepreneur Media today.
My pleasure, Veda, and thank you for giving me this opportunity, and look forward to doing more with you and your team.
Sure. Thank you.